If you view taxes purely as a math problem, you will miss half the equation. The wealthy view taxes as a toll booth, a predictable expense to be minimized and routed around. But most people view taxes as a mugging, a sudden painful loss to be feared or celebrated as a refund lottery. This psychological difference is why the rich get richer and you stay broke. Housel wrote The Psychology of Money, arguing that doing well with money has little to do with how smart you are and a lot to do with how you behave. The same is true for taxes. Doing well with taxes is less about knowing the IRS code and more about controlling your emotional reaction to it. Today I am exposing the 6 psychological traps that convert tax obligations into wealth-destroying behaviors. By the end of this video, you will understand why your tax refund is actually costing you money, why avoiding higher tax brackets caps your earning potential, and how the wealthy legally pay zero taxes using strategies hidden in plain sight. Trap number 1. The refund is not a bonus. In behavioral economics, mental accounting is the tendency to treat money differently depending on where it comes from. A dollar found on the street is spent differently than a dollar earned at work. For millions of people, a tax refund is the single largest check they will receive all year. Psychologically, this feels like a bonus, a gift from the government. It triggers a dopamine hit, similar to winning a scratch-off ticket. The poor mindset treats the refund as free money to be splurged on consumer goods, televisions, vacations, down payments on depreciating cars. The wealthy mindset views a refund as an error. It represents an interest-free loan given to the government for 12 months. It is capital that was not compounding. By over-withholding to force a refund, you are essentially using the IRS as a forced savings account that pays 0% interest. You are paying for your own lack of discipline. The wealthy person under-withholds legally to the safe harbor limit. They invest the difference during the year and write a check at the end, having kept the growth. Key insight. Wealth is not just about how much you keep. It is about when you get to keep it. Liquidity today is worth more than liquidity tomorrow. Trap number 2. The boogeyman in the bracket. There is a pervasive myth that keeps people from working overtime or accepting promotions. If I earn more, I will jump into a higher tax bracket and actually take home less money. This is the marginal tax rate fallacy. In a progressive tax system like the US, you only pay the higher rate on the dollars above the threshold. Example, if the 22% bracket starts at $47,150, earning $47,151 does not tax your entire income at 22%. It taxes $1 at 22%. The staying broke mechanism. Fear of the tax man causes people to cap their own earning potential. They irrationally avoid income to avoid taxes, which is like refusing to win a marathon because you do not want to pay for the cab ride home with the prize money. The wealthy focus on net income, not tax rate. They will happily pay $1 million in taxes if it means they earned $3 million. Trap number 3. The silent killer called tax drag. Compound interest is the most powerful force in finance. Tax drag is its evil twin. Most people obsess over investment returns. My stock did 10%, but they ignore the friction of taxes. Scenario A, the trader buys and sells frequently, pays short-term capital gains at ordinary income rates up to 37% every year. The tax bill resets the compounding clock annually. Scenario B, the owner buys and holds, pays 0% tax while the asset grows, only pays long-term capital gains at max 20% years later when they sell. The staying broke mechanism, churning. By constantly realizing gains by selling, you are voluntarily volunteering to pay taxes sooner than necessary. You are interrupting the compounding curve. The wealthy strategy is called buy, borrow, die. Buy assets that appreciate, borrow against them to live because loans are not taxable income. Die with the assets, passing them to heirs with a stepped-up basis, erasing the capital gains tax liability. This is not illegal. This is how generational wealth is built. The Walton family, the Mars family, every billionaire family uses this exact structure. They never sell, they never pay capital gains, they borrow tax-free and pass assets to the next generation with the tax slate wiped clean. Trap number 4, fee versus fine. Housel famously distinguishes between a fee, which is the cost of admission, and a fine, which is punishment for doing wrong. The middle class views taxes as a fine. It feels punitive, unfair, and personal. This leads to anxiety avoidance like not opening IRS letters and reactionary decisions. The wealthy view taxes as a fee. It is a cost of doing business like paying for electricity or raw materials. The staying broke mechanism. When you view taxes as a fine, you make decisions based on pain avoidance rather than profit maximization. You might buy a money-losing rental property just for the write-off. Reality check. Spending $1 to save 30 cents in taxes is not a strategy. It is a 70-cent loss. Never let the tax tail wag the investment dog. Make money first. Optimize taxes second. Never the reverse. Trap number 5. Reasonable versus rational. Sometimes the mathematically wrong tax decision is the psychologically right one for you. A purely rational robot would never get a tax refund, but human beings are not robots. If you know that you will spend every dollar you see in your paycheck, then over-withholding is actually a reasonable strategy. It forces you to save, protecting you from your own spending impulses. The staying broke nuance. The problem is not the strategy. It is the lack of self-awareness. If you need the IRS to be your piggy bank because you lack discipline, admit it, but do not confuse this weakness with a financial win. The goal is to graduate from reasonable, which is forced savings via refund, to rational, which is investing the surplus yourself. Use a high-yield savings account, use a brokerage account, use index funds, but stop giving the IRS an interest-free loan and calling it financial planning. Trap number 6, the comparison table. Here is the brutal truth in one image. The broke mindset says tax refund is free money, time to spend. The wealthy mindset says bad management, I gave an interest-free loan. The broke mindset says if I earn more, I lose money. The wealthy mindset says I pay taxes only on the margin, earning more is always better. The broke mindset says I spent money to get a write-off. The wealthy mindset says I only deduct expenses I had to incur to make money. The broke mindset sells early to lock in profit and triggering tax. The wealthy mindset defers sales indefinitely to let compounding run unhindered. The broke mindset focuses on minimizing the tax bill. The wealthy mindset focuses on maximizing after-tax wealth. Do you see the difference? One is playing defense, the other is playing offense. You cannot win a game by only playing defense. Here's the final thought. The IRS code is written in ink, but your reaction to it is written in dopamine and cortisol. Most people stay broke because they treat taxes as a terrifying event that happens to them rather than a variable they can manage. Wealth is what you do not see. Tax efficiency is what you do not pay. Financial freedom is realizing that taxes are just a toll on the road, not a reason to stop driving. If this video changed how you think about taxes, hit that subscribe button. The next video will expose the 15 forgotten tax laws that could save you thousands in 2026. Comment below which trap you fell into. Number 1, the refund trap. Number 2, the bracket fear. Or number 3, the tax drag. Remember, wealth is not about how much you earn. It is about how much you keep after taxes, and that is entirely within your control. See you in the next one.